Welcome back to MB Capital Strategies. In the last shipping video, we discussed the EU regulations coming into effect from 2026, ETS, FuelEU Maritime and CII, and why they will change the cost structure in shipping. Today, I want to address a topic that is often discussed very emotionally but rarely explained objectively: what real effects sanctions have on the shipping market. It's important to me to make this clear right from the start. This is not a political assessment and not an investment recommendation. I am describing solely what can be observed according to publicly available data, market reports, and industry analyses. I have linked all sources below in the video description. That means you are welcome to read through them again at your leisure. The reason for this video is as follows. In many discussions, the impression is created that sanctions would stop trade. However, if you look at actual trade flows, routes, and fleet movements, a different picture emerges. And it is precisely this discrepancy between public perception and market mechanics that I want to objectively clarify today: the sanctions paradox. Let's start with the basic market mechanics. Sanctions generally do not aim to eliminate the physical need for energy. Oil, gas, and other raw materials are still needed by industry, governments, and also refineries. Energy is not a consumer good that you can simply switch off. Refineries cannot pause the supply just because the political framework changes. That is why, in practice, the decision is not whether something will be transported, but how and at what cost. What changes as a result of sanctions is the framework of trade. Insurance, financing, flags, ports, and routes become restricted or more expensive. A pattern can be observed here that repeats itself historically. Even with previous sanction regimes, such as those against Iran or Venezuela, physical exports did not disappear. They shifted spatially and structurally. For the shipping market, this means when routes become longer, the number of ship days required increases. At the same time, part of the fleet drops out of the regular market due to regulatory or insurance-related restrictions. The result is a classic supply and demand effect. More transport capacity is needed while less tonnage is available. So what can we take away from this? Sanctions change trade routes, but not the physical demand. Everything comes down to supply and demand. As you know, a large part of my portfolio is invested in shipping, which is why I'm making this video. Among others, I'm invested in CMB.Tech, Flex LNG, Dorian LPG, TORM, BW LPG, International Seaways, Zim Integrated Shipping, Wallenius Wilhelmsen, Frontline, Diana Shipping, Höegh Autoliners, Hapag-Lloyd, Nordic American Tankers, SFL Corporation, Star Bulk Carriers, Oceanis Eco Tankers, TK Tankers, Costco Shipping, Genco Shipping Trading, Hafnia, and also Himalaya Shipping. Those would be mine. These are all my shipping stocks, which is why this topic is especially relevant to me. Dark fleet, why it exists and what drives it. In this context, the term dark fleet or shadow fleet is often mentioned. This mainly refers to older tankers that operate outside of traditional Western insurance and financial structures. Important, this is not an endorsement or recommendation of such structures, but rather a factual description of what, according to publicly available sources, exists. One aspect that is often underestimated in this context is insurance and reinsurance. For legal and regulatory reasons, many charters are only allowed to use ships that are insured by certain insurers and classification societies. If this access is lost, a ship is effectively unusable for the regular market, regardless of whether it is technically operational. And here comes the crucial effect: these ships do not disappear from the globe. They are simply no longer available to the regular market. Several industry reports estimate that a significant portion of the global tanker fleet now operates outside of traditional Western structures. That means it reduces the effectively available supply of tonnage. It's important to note, this effect does not only impact the so-called shadow market. The regular market also becomes tighter because fewer ships are available that meet all requirements. Regardless of any political assessment, this is a supply shortage, and supply shortages are one of the main price drivers in shipping. Routes and tonne-miles. Shipping is not determined by narratives but by physics. The decisive factor is distance. A term that often comes up in this context is tonne-miles. It is nothing more than the volume of transport multiplied by the distance traveled. If the route becomes longer, the required transport capacity automatically increases, even if exactly the same amount of oil or gas is being transported. This can be observed when certain regions are bypassed or trade flows change. Depending on the route, these detours can increase the transport distance by 10 to 20%. This ties up the ships for longer and reduces the capacity available in the short term. And this effect is purely physical, independent of political objectives. Now comes the connection to the EU regulations starting in 2026. EU ETS, FuelEU Maritime, and stricter efficiency requirements increase costs in the regulated market. Regulation rarely takes effect abruptly. It works through expectations and behavior. Ship owners, charterers, and insurers often adjust their decisions long before the official start date. This can lead to certain ships becoming economically less attractive or disappearing from certain markets. This too reinforces fragmentation and scarcity. From an investor's perspective, it is important to distinguish between book values and actual use. An asset may be written off on the balance sheet but still be used operationally or not. Volatility does not necessarily mean insolvency risk. What matters are the balance sheet, debt levels, and actual demand. You can also check out my recent shipping video, which I'll link up here, the last shipping video I made, where I discuss how the shipping industry is going to change. Feel free to watch it. It's a really fascinating report. So what is my conclusion? This assessment does not evaluate any political measures. It describes how sanctions and regulations are changing real markets. If you want to understand markets, you don't have to approve of everything, but you do need to comprehend how physical mechanisms work. I wish you successful investing. I hope you enjoyed the video. Feel free to leave me a comment, and if you haven't subscribed yet, I'd really appreciate it if you did. See you next time.